This is how angel groups typically work. First, you have some deal flow. You locate, or a deal is submitted to you, and it's interesting enough to take a look at. There's a group that nominates themselves as pre-screeners. These are the guys that are willing to take a look at stuff that comes across the transom, break it open, and say, sure enough, let's take that little nugget to the next step. In our case, we have a monthly pre-screen call. So it's a subcommittee of Sand Hill Angels. And by the way, real quickly, Sand Hill Angels, about 80 total people, 60 of whom are active at any time. Monthly meetings, we have about 30 to 40 people show up, and there's about 10 people that sit on the pre-screen committee. Give you a sense of size. So the pre-screen committee comes in and narrows deals down to 6. The pre-screen guys go out and then talk to the companies, do a little more due diligence, listen to their pitches, and try to narrow down the deal flow to 1 or 3 that is presented at a monthly meeting. Monthly meeting is a dinner meeting that we have. Wine is served. We have an hour worth of networking beforehand. You kind of catch up on what people are doing. Then we all sit down in a large room, and companies come in one at a time and pitch. Pitches typically last for about 20 minutes, and we have 5 to 10 minutes worth of review session privately after the fact. Everybody's got a sheet of paper that sits in front of them. On the sheet of paper is, are you interested in this deal? Yes, no. How much would you like to invest? Typically a $10,000 minimum. And then how much are you willing to help with due diligence? If we collect those papers at the end of the evening with everybody that's in the room, and there's $100,000 worth of overall interest in the company, then we move it to the next step. If it falls below that threshold, we don't push it forward. If it's well above that threshold, then it kind of goes into accelerated mode because there's a lot of good interest. Please. Yes. So the question was, what about tax issues regarding angel groups in the U.S. that want to invest in Canadian companies? So from this perspective, there's no tax issues whatsoever. They're treated exactly as income that would be. So if I'm investing in a company in, outside of my immediate area, Reno, Nevada versus Victoria, from a tax perspective, it all looks the same. Whether I make money or whether I lose money, capital gains, capital losses, all that. The major difference is something you hear about once in a while called Section 116, which is a withholding tax that's based on an exit. And the Canadian government requires 25% withholding for some period on gains that are exited by a foreign-owned corporation. And then you have to go ahead and spend some legal expenses and apply for that, and it's got to. If all else is equal, you probably have that right today. But 2 things are happening. First, the government, I'm from the government, so I can speak at least from what I understand, is the legislative bodies believe that they have already solved this problem, and it just hasn't been properly written into law yet. But, so there's a big focus right now. We had the Minister of International Trade down a couple weeks ago. We had 10 guys sit down and talk to them about this. This will get fixed, and therefore it will be a level playing field. So thanks for the question. So yeah, I'll leave it at that. So we have a $100,000 minimum threshold, and then the people that have signed on their sheet of paper that said they want to be part of a due diligence group, all get together offline, say, okay, I'll take a look at the legal side, I'll take a look at the business side. You sort of pour open the company and sort of see what the risks are. In most cases, you're looking for something ugly. You're already excited about the deal. Now you're trying to convince yourself not to invest. And a lot of cases, you'll find stuff, and I'll go through a couple lists here real quickly. But if it does pass due diligence, then we negotiate deal terms. We'll talk about deal terms in the next section. Write a term sheet, draft it, write some checks, and off we go. In terms of deal flow, this is probably at the high end, a VC deal flow where DFJ, one of the largest funds in the Valley, sees 30,000 plans a year. They review every one. They have 750 first meetings, 150 follow-on meetings, and invest maybe one or two a month at the end of the day. So that's a typical deal flow. If you're an entrepreneur looking to raise VC capital or angel capital, it's kind of the same ratio. So it's, for those that have got a really strong business plan, it's between 1 out of 10 and 1 out of 100, depending on your space and depending on the current economic climate. For us, we review 750 plans, so it's about 2 a day. We get in over the transom. We do about 100 meetings and or phone calls. 72, like I talked about, make that pre-screen. 36 we talk to personally, I see every year, and then we make 4 to 8 investments per year. You are part of an angel group or an angel network, or you're actively looking for things, you'll be surprised how much stuff sort of bubbles up through your day-to-day interactions. Events like this, trade shows, seminars, workshops. You'll see, hopefully, several companies out there that make really interesting investment prospects, and off you go. Syndication, if an angel group is working with another angel group. We personally do a lot of work with life science angels, because it's full of doctors, they see the hardcore medical tech deals, and they want our medical deals, and they want our advice on the technology side of that. We get together and match up. There's also something called AngelSoft. Take a look at it, angelsoft.net. Both as an entrepreneur and as a potential angel investor, it is the portal that's emerged as the source for angel investing, angelsoft.net. I should have had a screenshot for you, but it basically allows you as an entrepreneur to submit deals to various angel groups around the world, and you as an angel group can see deals and sort by local area, by functionality, by stage of company, by whether they're serial entrepreneurs or first time, all that kind of stuff. It's pretty cool. So I recommend you take a look. So what's a good angel deal? Well, smart team, easy to work with, done startups before, good track record. This is kind of interesting. Typically, a company has one significant thing they need to accomplish. I want to get to a prototype stage. I want to get my first customers. I want to get to cash flow positive. And if you can identify it's only one thing, that means you have relatively little risk. Identify that one thing that the company can do with your money, then it's probably more likely for you to invest in it. Bad deal, 4 or 5 risky things. You've got a lot of moving parts going on, and it's difficult to track. So team is missing key people. They need people to go ahead and complete those things, if you will. And the things are highly specialized. They're rare and expensive skills. Or the deal's worn. It's been shopped around. You see a lot of these in the angel world. They've already tried to go to government who's turned them down, to VCs who have turned them down. And oh, you know what? Maybe I'll try to raise some angel funding. Well, there are reasons why they got rejected in the first place. They should work on and fix those reasons and then come out and start fresh with brand new people. This is just to show you that there are ways to go ahead and do sort of deal rating. This is one example that we used as part of a boot camps, the series of boot camps that we ran up here in Canada. But management team, customers, market, business model, competition, product, financials, these are all things that would make a superior company or could kill a company at any point along the line. And again, we're going to hand out slides if you like, so you can get a copy of this. So due diligence, usually there's something down here that hurts. What was that? Why? Can you fix it? Don't fall in love with a company until you understand, what might not work. What's interesting here? Team, of course, market timing, products and services. You get the idea. The 3 types of due diligence. Business. Is it a good business?